Hey, everybody. Welcome to the podcast. Happy New Year to you. Today is January 4th, and I was just looking here. The last time there was a podcast done was December 19th, so it's been quite a while. Obviously, the holidays, and then New Year's Day, I had a severe headache. The chills came, and lo and behold, influenza A. So I had that for New Year's night. Actually felt better the next day, and just very congested, the whole shebang. And now that you know my whole medical history, I will probably be clearing my throat. I will probably be having a little bit deeper voice than normal, but I feel okay, and that's the important thing. And I've been battling through and working through the last few weeks here, even through the vacation. Things have been very, very busy. You know, down here in South Texas, we have the Eagleford Shale area. I've been talking to a lot of folks from down in that area. And, of course, in the markets, it's been very exciting. Depending on which side of the trade you're on, it could be horrible, I guess. But I think a lot of people have been sitting things out and maybe are starting to regret it. I don't know. But we'll have a lot to discuss. I'm going to try to keep it short. Of course, I always say that, and they end up going a little longer than I thought. We got a lot to cover, so let's jump right into it. After the big couple of days, 31st and then the 2nd of the year, the big days we had a little bit of a pullback yesterday, not much at all, and then the Dow actually finished up 43 points today. Transports, as you can see, very, very strong again. Financials have been strong. It's an area I'm long and have been for a couple of months. Treasuries interest rates keep going up while gold continues going down, and we'll talk about both of those. But you can see volatility up there continue to compress. It's under 14 now. That's kind of a warning sign for some people. Again, we'll talk about that and see if it should be a warning sign or not. And a lot of stuff to jump into. Let's get to it right now. All right, let's first jump into the S&P 500. As you can see, we're obviously at this, what I guess could be a quadruple top now. It was a triple top back over here. We hit the top here once, twice, 3 times a lady, and then down we went, and now we are testing this. So intraday, it's been higher, but on a closing level, I think this was the highest closing level we have had. And basically, we've been straight up since after the fiscal cliff. And as I had told you on the podcast a few podcasts ago, I thought we would technically go over the fiscal cliff because all these great politicians could come in and actually cut taxes. And you're saying, wait a second, didn't taxes go up on a lot of people? Yes, they did. But remember, they defaulted because the Bush tax cuts expired technically, and then they came in and extended some of them and raised some of them. But for the most part, a lot of Republicans felt easier to vote for this after it went over the cliff. So technically went over the cliff. I think things could have been much worse. And I think overall, when you look at this, it didn't do a thing to help out the deficit. And so from an American standpoint, things did not get any better. From a stock market standpoint, I think they did because, number one, we have some clarity a little bit. We know what the taxes are going to be. We know that, yes, in 2 months we're going to have this, debt ceiling debate once again. And as somebody said, if you came home and your house was full of stuff, I'll just say it's stuff. It was another S word, but stuff. It was in an email. And it was filled up to the ceiling with this stuff. Would you try to clean out the stuff, or would you just raise the ceiling in your house? Well, they're going to try to raise the ceiling in the house and put more stuff in there. And so that's something that the market's going to have to deal with. But for right now, what's happening in the big picture is that we have global growth has started to stabilize. So growth was decelerating in China, in America. It's starting to stabilize. You're seeing some good numbers come out of China lately. Obviously, housing has improved a little bit here, and we're growing at maybe a couple percent. And we probably avoided a recession because of the fiscal cliff stuff they did. So given all that, you're seeing money rotate into stocks. You're seeing money rotate out of bonds. And we'll take a look at bonds very quickly and rates. And you can see they spiked up and obviously broke out of what had been kind of this little box. And now they've broken out. So, where do they head? They probably could get up to 2.2% somewhere in this area up here. So we'll talk about that. But going back to the S&P for a minute, so money's flowing out of bonds and into stocks, and it's flowing out of gold into stocks. Primarily, with more growth on the table, people don't want to own bonds. And then you had yesterday the Fed come out in their minutes and basically say a few people felt like they should stop with the bond purchases as early as late 2013. Well, I think that's just jawboning. This is Q eternity. We know this because they've already said the last meeting, an interview, that they wanted to keep purchasing bonds at least until unemployment got down to 6%. Look, that's not going to happen until we get to 2015 probably. So, people can say they want to stop, but they're not going to. They're still money printing. So that means that I think you can still own gold. And I don't own a bunch of gold, but I have it as more of a core position. If you own too much of it, then you should be worried about it because it has been going down. If you take a look at the GLD, had a nice reversal today. In fact, if you look at the 5-minute picture, you can see it kind of bottomed out around noon and then rallied the rest of the day. But overall, it is it's been having a tough time. But look, I think overall gold is still the place to be when we look at it long term. And there's nothing to change that. They're still printing around the world. They're still printing here. Fiat money is not worth anything, and so eventually, gold's going to continue to do well. And I think today was the first day you're starting to see a positive divergence build, and so we may have had this kind of double bottom here. I'll zoom in a little bit, but some of the oscillators we watch actually are making higher lows. You see the volume was a little higher today than the past few days, so I think gold's setting up, but I'm not really trading it. So I'm telling you a trading thing, but I'm not really trading. I've got a small piece of gold. But Byron Wien, who does his predictions every year, thinks gold will be at 1900. That's a nice little advance from where it is today. So again, it should be a piece of the portfolio, I think. Let's look at something like transportation. The transport index broke out, came back down, and now it's off to the races. Obviously, industrials have made a new 52-week high, and transports are doing very well. So whether you like it or not, the economy is in a little better shape than probably a lot of people thought it would be. It's not rip-roaring, but it is having some people who are worried about a dramatic slowdown, maybe having to rethink that. And so you're seeing money flow into risk-on assets, places like financials, which I own, places like small caps. Those are areas that have seen new highs. So we're seeing all of this, and at the same time, we're seeing money flow out of bonds. Interest rates going up, bond prices go down. If you take a look at the TLT, the safe haven, actually going down, and actually turned around and had an update today, but it's been going down in the last few days, few weeks really, since we've been getting better economic news. Now, we have all this stuff to deal with coming up, but it seems like we always have something to deal with. So what you have to do is have a multi-pronged strategy, which I have been an advocate of. And what that basically looks like is, again, having that core piece of income coming into the account all the time, having some things you trade, having some things that are value conviction. I don't care about the charts. I'm going to buy them because they're just cheap. And then having some systems in place that allow you to participate in what's working. For example, right now, financials are working, REITs are working. That's money is going into areas that were either depressed coming into the fiscal cliff, or they've been strong. I mean, financials are getting strong because the yield spread is widening. Long-term rates are going up, short-term rates are staying low, so the banks are able to make more money. So financials are doing extremely well. And you look at something like, let's look at Kinder Morgan Partners, which is a holding of mine. This is a company who was getting hit really hard. When did it get hit? Coincidentally, right after the election. Why did it hit after the election? Because people fear Obama would raise taxes and change the tax structure on MLPs. And so I didn't sell mine because I was looking at it going, look, they may change the tax structure eventually, but it's not going to be in this round of the tax discussion on the fiscal cliff. And sure enough, it wasn't. So after the fiscal cliff, you get this big move up. So, and a 6.4% dividend yield. That's the kind of stock that still makes sense in this environment. It's in energy. It's doing a lot of stuff. You got 6.5% yield. People sold it because of the tax consequences, which was the wrong thing to do. And now it's going back up to its old high. I know some people who I've talked to a lot that are in this industry, love the MLPs and bought a lot of it down in this area in here. And kudos to you. You know who I'm talking about. Did very well by buying those down there. So there are places to be. Also, things like municipal bonds. People were worried about them, the taxability going away on them, or the tax freedom going away on them. Did not happen. So a lot of these things have reversed that people were worried about. So that's one thing. But overall, there's a shift into stocks simply because maybe people had sold last year to say, hey, I'm going to sell. And I'm going to sell because I'm worried about taxes, and I'm going to lock in profits. And then if taxes aren't that big a deal, I'll buy back in. I don't necessarily understand all that because now they have taxes to pay, and then they end up buying the position back higher. Doesn't really make sense to me, but that's what's happening. But overall, in the very, very short run here, the stock market is obviously at this top, and I would love to see from getting new cash invested, a pullback. What you have is these moving averages. I'll even take the 20-day. You can see it's pointing up. I would love to see a pullback to something like that, and then we blast on through it. But markets aren't always predictable, but the bottom line is all the things that we look for in a bear market aren't really present right now. When you look at the number of stocks advancing versus the ones declining, even when you look at just the operating companies, a lot of those are making new highs, and that's not something you typically see at market peaks. You also don't see just the intense demand we're seeing. We're seeing demand go up at the same time supply is going down. We're seeing financials participate. We're seeing tech participate. It's pretty broad. We're seeing industrials, transportation, all of those things work. And so the point is that you should be participating in this market. Some of you may be completely out because you were so worried about the fiscal cliff and the world's going to hell in a handbasket. And I will admit that it's very, as boring as it seems. Of course, I had the flu. I was flipping between C-SPAN and football. And now most of us spent on football, but I did watch some C-SPAN, and watching this is a joke. Again, they haven't done anything to fix any of these problems we have to cut spending, but they're going to be forced to at some point. And but the bottom line is we can't change that as individuals. What we can do is make money while it's there. And that's my job, is to help you make money. What I'm seeing is a lower risk right now. In the very, very short term, though, some of these things are stretched. And again, I'd like to see a pullback, maybe even to 1430 would be really nice. It'd be like a 2% pullback. But who knows if we get it? Sometimes markets just run away from you. Okay, I want to point something out. There's a lot of talk today about the volatility index, and you can see it closed over here at 13.83, so under 14. And a lot of people say, boy, this thing, when it gets under 14, we need to watch out. The market's going to pull back. And that could be the case for the short term, but I want you to look at this from a longer term perspective. You really have two different time frames here. You have prior to 2008 and post 2008. Prior to 2008, let me get some of this off the screen and go back. The VIX spent a lot of time below 14. So the horizontal line's 14. You can see we spent almost 3 years underneath 14. If you use a moving average, it spent pretty much, if you just use a 10-week moving average, it spent all of 05 through 07 in sub 14 level. And that was a time where the market, if you recall, and I'll go ahead and put it on the screen, the S&P in blue just meandered up. So the period we're talking about right now is right in here. So you can see the S&P just meandered up, had a pretty good 05, 06. And then, obviously in 07, it got very elevated. I would say that it was pretty much the time frame where it kind of broke out of this, which was right here. And that's when things started to get toppy, and of course the market went through its horrible bear market. But it's distinct time frames. So before we look at this, what's going on today, and I'll just zoom in on that. Before we look at this and say the market is going to fall apart, the thing we have to determine is, are we in a different time frame? Are we going to enter a time frame where the VIX just stays down here? I don't know the answer to that. I'm simply pointing out that we can't jump to conclusions, easy for him to say, and say just because the VIX is sub 14 that the market is destined to go down. I think what I like to look at is obviously how fast these things are going up or down. And what we're seeing is money's coming out of the VIX. I think partially it's explained because people put on insurance going into the fiscal cliff. And we saw a big run up. If you zoom in here, you'll see this big run up into the fiscal cliff, preparing for a fall in the market if they didn't get anything done. It was an insurance policy. And now they're undoing that, selling that insurance policy. And that's why you're seeing the VIX fall, but it's falling at a tremendously fast rate. So if you're long the VIX, you're getting hurt very, very badly. So anybody that's short, anybody that's long the VIX has been hurt very badly the last few days. But the thing is, now that it's down at these levels, is it time to reload on insurance? And I would say not necessarily. I don't know if we're going to stay at these levels, but I'm pointing out to you that just because we are at sub 14 does not mean that the stock market's destined to go through another 6-month drop or something like that. So take that for what it's worth, but you have to look at history when you're looking at this stuff. All right, I will leave you with this because I can't stand hearing my voice like this, and I'm sure you can't either. But have a wonderful weekend. And listen, the thing right now that you have to do is if you're over-invested, meaning you're fully invested, you're really happy you had a good week, go ahead and take a little bit off the table perhaps for a trade if you're into that because things are stretched to the upside. However, in the medium term, look for some buying opportunities because the stock market has definitely been firming up, not only in the short term, but in the little medium term. And economic news isn't great, but it's been better, and that's the key. It's been better, and there's one more thing to check, which is the fiscal cliff is now in the rearview mirror, and that's given investors a little more confidence. So, but watch this top that I got on the screen here because this 1466 level is an area maybe some people who got in down here were looking as an area to sell into. So look for some weakness maybe early next week, and if we can get a pullback maybe to 1430, something like that, then I think you're free to buy a little bit more. But just be strategic in what you're doing. Do not let your guard down because we're in a new market now that you can never let your guard down. And so don't just throw caution to the wind. Be very strategic and mindful of what you're doing and have some systems in place. But anyways, thanks for bearing with me today. Sorry the podcast has been long coming, and look forward to 2013 with you guys. Be doing more articles. Still doing a lot of new things that we're going to be putting on the blog this year. So, and keep the questions coming. We'll try to answer those in the future podcast. Thanks a lot, everybody. Don't forget to check out all the websites if you're new. KarlEggers.com, Twitter.com/KarlEggers, Google+, Facebook, EggersCapital.com. Take care.